Hey, what's up guys? Welcome to another video. Yes, I know it's been a while since our last video, but it's just been a crazy hectic time right now. Anyway, a lot has happened around the world in the last year, and it's impacted many stocks. So we thought we would give a review on these three property companies, which are Kiwi Property, Argosy, and Precinct Properties. If you want to watch the original analysis video on these three companies that we did last year, we'll leave a link for it in the description below, or you can just click one of these pop-ups that come up. But for now, let's get right into it. Let's begin with a quick recap on each company before we get into the whys. So beginning with Kiwi Property. Last year when we did the video, it was around early June. And at the time we mentioned that Kiwi Property would be a high risk buy, as a lot of their revenue is dependent on Sylvia Park, which was closed for most of the year. At the time of our last video, Kiwi Property was trading around the $1 range, except for that little spike for a couple of days. And now it's currently trading at around $1.20. So a little bit of a comeback in terms of price, but nowhere near the pre-pandemic price, which was around the $1.50 mark. As for dividends, which is probably one of the most attractive components to buying a property stock, Kiwi Property last year skipped its final dividend for FY20, which is understandable as there was a lot of uncertainty going forward. However, recently, Kiwi Property released their FY21 results, in which they mentioned that they will pay out a 2.95 dividend per share. As for the rest of their results, in FY20, their net income had a loss of $186.7 million due to a non-cash $289.9 million decrease in valuation of their property. On the other hand, in FY21, their net income after tax was $196.5 million, where $99.8 million was from gain in valuation. But if we have a look at their adjusted funds from operations, which describes the underlying cash flows from operations, FY21 was actually lower than FY20, with $89.4 million versus $102.2 million, due to the $15.2 million capitalized rent abatements for COVID-19. Moving on to Argosy. At the time of our video, the stock was trading at around $1.20, and we mentioned that Argosy would be the least risk buy out of the three companies, as it had a lot of smaller properties which they were able to liquidate quickly if needed. From memory, I think it was around $400 million worth of property that they could easily liquidate. Now, from that point on, the share price of this company has been on a constant rise, and it currently trades at around $1.50 range, which is really impressive as it's recovered from its pre-pandemic days and then some. As for the dividend side, unlike Kiwi Property, who did not pay out a final dividend for FY20 due to uncertainty, Argosy was confident enough to pay out a final dividend last year, in the same range that they usually do. 1.58 cents per share, not even a reduced one, which is pretty impressive considering the world was going under. After that, they paid out 3 more interim dividends and recently announced a final dividend of 1.63 cents per share. Unlike KPG, Argosy did not devalue their property in FY 2020, and their net income after tax was $119 million, where $59 million was from revaluation of their property. In FY 2021, they reported a $241 million profit, largely due to their property valuation gain of $157 million. In terms of adjusted funds from operations, for Argosy, their earnings actually increased almost $9 million, from $51.8 million to $60.4 million. Which explains why their stock had such a strong recovery past their pre-COVID price, as this shows how resilient their property portfolio is. As for the final company, Precinct Properties, about the time we did the video last year, the company's future was looking bright in the light of Commercial Bay opening, which was reflected in the share price as the price was hovering around the $1.70 mark. But now the share price has taken a little dive and is hovering around the $1.50 mark. So not a huge downturn, but trending down currently. As for the dividend side of things, they've been consistent with their dividends, paying FY20 final dividend during an uncertain future, and a massive Commercial Bay opening that could have gone either way. On top of that, paying 2 more dividends and recently releasing that they will pay out a 3rd interim dividend of 1.625 cents per share. Precinct Properties' FY21 results will probably come out in August, but their interim presentation guidance suggests that their adjusted funds from operations will be 6.5 cents per share, which is roughly about $85 million. If they do meet this, it would be a 3.2% increase from FY20 adjusted funds from operations of $82.7 million. Now that we've gone through the company's results / 1 year progress, let's talk about the biggest changes these three companies have made in terms of property development. In last year's video, we talked about many of these properties being still under construction. So let's begin with Kiwi Property.
In the past year, a few notable things happened with KPG. In FY21, KPG stepped up their portfolio rebalancing program with the aim of reducing their exposure to regional retail and recycling the capital to fund their growth pipeline. As part of this plan, their shopping centres, the Plaza in Palmerston North and Northland in Christchurch, were listed for sale. According to the FY21 annual report, they are currently in negotiation for both properties and will provide an update to the outcome of the transaction in due course. Moving on to Sylvia Park. Last year in October, Level 1 expansion of Sylvia Park finally opened, and they have said the expansion has performed well since opening, underpinned by robust sales across specialty stores and the terrace at Sylvia Park dining precinct. In last year's annual report, KPG said that following the success of ANZ Raranga Office Tower, planning is underway for a second commercial building at Sylvia Park. And now the plan for a second commercial building has been confirmed. In April this year, KPG has given a green light for a second commercial building, which is going to be a 7,450 meter squared 6-story office building that will cost $64 million. Also at Sylvia Park, consenting process is underway for build to rent. Finally, the Jewellery project. The 51-hectare master planned community at Jewellery, which aims to create a town centre catering 60,000 people over 20 years, had substantial progress in FY21. Reflecting the potential for our Jewellery development to unlock housing, jobs, and support economic recovery, the Minister for the Environment is currently processing a fast-track application for the project under the COVID-19 Recovery Act 2020. If successful, the application could enable earthwork to begin at Jewellery in FY22, which is up to 3 years ahead of schedule. For Argosy, beginning with the Albany Lifestyle Centre that the company intended to sell to the buyer Kiwi Property Group, who had made a non-refundable $4.5 million deposit, but then defaulted on the purchase as they could not make a settlement due in uncertain times. Argosy announced that it will retain the $4.5 million non-refundable deposit and will continue to receive rental income from the property. Fast forward to 2021, the company's transaction went through May 1st and was settled for $87.5 million. Moving on to the 11th floor Willis Street development in Wellington, which we mentioned in the last video was expected to be complete in 2021. However, since then, the company has released that they will add another floor to the development due to the tenant, which is Statistics New Zealand. The addition of another floor to the initial plans will cost $6.8 million and deliver incremental income of $0.7 million. This, along with the increased cost caused by the delays to the project, have increased the expected total spend to $140 million, which is around $30 million increase. The net rental for this building is now expected to be $7.4 million. The expected end value of the property, including the land, would be around $150 million. The initial rate of return has been stated at 8.2%, but now the rate of return is expected to be 7.2%. Now the Argosy expects the completion of this development to be February 2022. Last year was a big year for PCT. After 4 years of construction, their $1 billion commercial bay opened. In their last interim result, PCT have said commercial bay operating income was lower for the first half due to timing impacts from COVID following delays in opening. The trade performance continues to track in line with expectation after adjusting for no international visitors. Also during the year, PCT entered into an agreement for the sale of its 50% interest in the ANZ Centre in Auckland for $177 million, and in April, the agreement went unconditional. In terms of the new development, PCT has announced November last year that they will be committing to 44 Bowen Street, the second office building of Bowen Campus Stage 2 development in Wellington. The new building will provide 8 levels of office accommodation, totaling approximately 11,549 meters square of office NLA, including the ground floor. Although the project is expected to be completed in the first half of 2023, PCT has recently announced that full lease for the building has been secured, with NZTA occupying 6 contiguous floors in the 8-level office for 12 years. Finally, PCT announced on 24th of May, construction of the 1 Queen Street redevelopment will shortly commence. Building on the success of Commercial Bay since opening up almost 1 year ago, this second stage will comprise a luxury hotel, premium office accommodation, and a variety of unique food and beverage options, with completion due in late 2023. The total project cost is expected to be around $305 million, with an expected yield on cost of 6.2% once complete. So that was our update on all 3 companies. We tried covering all the major and notable changes that have happened in the last year. Surely it has been a wild ride in the last 12 months. Let us know your thoughts on this and which of the 3 companies going forward you think will be the best property stock on the NZX. Also, if you like these sort of update videos. But as always, make sure to smash that like button and the subscribe button if you haven't already done so. We'll catch you next time.